Let's continue this conversation now with Priya Misra, who is TD Securities Managing Director and Global Head of Rate Strategy. Priya, thank you so much for being here. So we just had a discussion about the Fed, what's going to happen now for the next few years. I'm curious your take on rates then, the feed through to rates. Like, are we just going to see a range-bound 10-year over the next year, even as the Fed is raising rates because of the outlook for economic growth or lack thereof?
I think we're likely to see a cap on the 10-year, particularly because long and real rates have risen. Whether we stay in a range or not really comes down to, can the Fed achieve this softish landing, which I now think increasingly becomes a myth. If they're going to go 75, we're looking for them to hike 75 this meeting, 75 in July, then 50 basis points, taking the terminal rate to 4%, along with QT. That's a significant amount of tightening. Can the consumer handle it? Can interest-sensitive sectors handle it? And so I actually think the 10-year reaches a peak in the near term, and then I have a downward trajectory for the 10-year. I think the front end can be more range-bound because the market's already pricing in all these hikes. But the long end, as the market starts to get concerned about a hard landing, about rate cuts, late 23, the market's already pricing in rate cuts. I think actually the 10-year might be the safest place in town, which sounds counterintuitive if the Fed is hiking a lot, but it starts to price in that growth slowdown and the eventual Fed eases.
Priya, let's say the Fed comes out today, raises rates by 75 basis points, which appears now to be the consensus going into the meeting. What are the ripple effects of that move over the next few weeks?
So I think the 75 is priced in. Whether you look at rates, I'm not an equity analyst, but I would think that it's generally priced in. The issue is, I think, forward guidance, as we have been used to now for 15 years from the Fed. And particularly in the last few months, I think what was important was in May, we got the guidance of 250s. I think that's over. Even if Chair Powell tries to give forward guidance, which I think he may not, because if they're trying to be data dependent, it's very hard to give a lot of guidance. But without any forward guidance, the market's going to stay extremely volatile. If we see inflation staying high, and a lot of the inflation, I have to argue, is outside of the Fed's control. Long term, sure, they can impact the economy and that impacts inflation. But food, energy, shelter, these are things that actually the Fed doesn't have a lot of control. What if inflation stays high longer? I think then the market gets nervous that is 75 the new 25? And is the Fed going to get to 5%, 6%? What's the level at which point, the Fed stops? That's what the market's going to be concerned about, and the ripple effects on growth, on risk assets. So I think beyond the 75, which I think is baked in, it's really economic data and how the Fed responds to it. And do they try and manage the dual mandate, or is inflation such a big problem that they're going to let the softish landing goal, I think, go away for now?
And for one of the Fed's favorite measures to track where the appetite of the consumer is and where the strength of the consumer is, or lack thereof, in the personal consumption expenditures as well. In this data, when do you believe that it will further start to show up and be even more of a kind of blaring alarm to the Fed within their own policy pathway right now?
That's the key question, right? At what point does the consumer struggle? I think we've already seen in the first quarter a reduction in goods demand. But that's good. No pun intended. Goods demand was running much above trend. A lot of that was because of COVID. So some of that decline was expected. I'm sure the Fed is happy with that. It's the service sector. Does service demand start to slow? But again, I would say the Fed is trying to raise rates and tighten policy to slow demand. I think what they're trying to do is slow demand to the point where you reach trend and not go below trend. That's a slippery slope. Is there enough tightening in conditions? Does the job market start to show some signs of cracking and it starts to soften below? We think that's closer to year end, not just yet. But I think the slowing is baked in the cake. We're going to get the slowing. We just don't know if it's slowing enough below trend. And I think that only happens closer to year end because there's still a lot of momentum in the consumer.
And as you said, Priya, we're now getting the outlook for rates to be cut, right? And this is a little bit the phenomenon that we just heard Miles talking about, this sort of like, hurry up and let's get past this period of recession and of bear market, and let's get to the period where we can see loosening once again. Do you think that's the right way to think about it? How are you thinking about sort of this period, this cycle?
Right. So if you've tracked the last few cycles, I think that's been a good philosophy. I struggle a little bit now with inflation because I think there's persistence to inflation. Unless you think the war gets resolved or China gives up on zero COVID. What worries me is how does the Fed respond? And actually, I'll be watching for the SEP as well as the dot plot. And if Chair Powell can give some sense of this. If growth starts to slow down, I don't want to use the word stagflation, it's misused a lot, but what if growth slows to below trend? So 1% growth, and inflation is still 3%. So now they're potentially missing on both sides of the mandate. What do they give more priority to? How do they try and balance their dual mandate that's potentially going to be in conflict? We actually think it is going to be in conflict next year. It would be easy for them to cut if inflation wasn't a problem, but inflation may stay a problem for much longer. It tends to be a very persistent series, responds only with a big lag to monetary policy. So I don't know if they'll have that flexibility to start to ease or even stop hiking, even if growth slows down, because inflation is just uncomfortably high and expectations are starting to rise on inflation as well.
Well, hopefully we get some insights into all this later on when the Fed announces its decision. Priya Misra, TD Securities Managing Director and Global Head of Rate Strategy. Good to see you.